Welcome to the Deep Dive. We're here to deliver the essential truth about complex subjects, and today, well, we're diving deep into the Nordic financial world.
We are. Our focus is Tryg AS, that's ticker ATRYG.co. They're the biggest non-life insurance player in that really stable, wealthy part of Europe.
And we're working from a detailed investment analysis today. Our goal is to figure out why they're number one.
Exactly. And, the core idea, let's just put it out there right away, is their underwriting profitability. It's simply better than everyone else's.
Superior underwriting. So doing the actual insurance part better.
Precisely. Assessing risk, pricing it right, handling claims efficiently, that's their edge.
And the numbers back this up strongly, right? That combined ratio figure is central.
Oh, absolutely. It's industry leading. For 2024, we're talking 81.0%. That's exceptional.
81%.
Yep.
So just to remind everyone, lower is better here. It means costs and claims are only 81% of the premiums they take in.
That's it, exactly. For every 100 kroner in premiums, they're making 19 kroner just from the insurance operation itself before any investment income. Most competitors would kill for a consistent 95%.
Okay, and that kind of reliable profit machine, what does that enable them to do? What's the consequence?
Well, it leads to a really strong balance sheet, like a fortress. Their solvency ratio, that's the measure of their capital buffer, was 196% in 2024. Super solid.
And that strength allows them to be pretty generous with shareholders.
Very generous. They've committed publicly to growing dividends every year. Plus, they do things like share buybacks. There was a DKK 2 billion program announced late 2024 to return extra capital.
Okay, so that's the positive story. Dominance through discipline, leading to big returns. But it can't all be smooth sailing. What are the main risks, the counter-arguments we need to keep in mind?
Right, there are always risks. The analysis points to three main tensions. First, they're dominant, but the Nordic market itself is mature, it's concentrated.
Meaning tough competition among the big guys.
Exactly. Fighting for market share limits how much they can easily push up margins. Second, there's the weather. Climate change means more severe, more frequent catastrophes. 2023 was apparently a record year for claims because of this.
That sounds like a direct hit to that combined ratio.
It is. And the third risk actually ties back to those shareholder returns we just mentioned.
How so?
That promise of growing dividends every single year. It sounds great, but Moody's, the credit rating agency, they flagged it. They called it a constraint on Tryg's A1 rating.
A constraint, meaning it limits their flexibility.
Yeah. It suggests that while their capital is fine now, the policy means they might have less room to maneuver if, say, several really bad catastrophe years hit back-to-back. It's that classic trade-off. Return capital now or keep more in reserve for a rainy day or perhaps a very stormy day.
Okay, let's ground ourselves in the company itself. Tryg isn't some new disruptor. They've been around for centuries.
Over 3 centuries, yeah. That kind of history matters. It builds trust. And today, they're a proper blue-chip stock on the Copenhagen Exchange, part of the C25 index. It's a pillar of the Danish financial system, really.
That longevity must count for something with customers. But what about the scale today? How big are we talking?
Pretty big. End of 2023, almost 6,900 employees. And revenues, trailing 12 months, were around DKK 40.86 billion. That scale is key.
And scale means they can invest more in things like tech and data.
Absolutely. That's a huge differentiator. They're not just using standard industry models. They pour money into advanced data analytics, proprietary algorithms. They can slice and dice risk at a really granular level.
So they can spot the safer risks better than others.
Exactly. They can identify why one house or one car is statistically less likely to have a claim than the average, allowing them to price more competitively for those good risks, while maybe avoiding or pricing higher for the ones that look riskier under the surface. It feeds right into that low combined ratio, along with efficient claims handling.
Right. Let's zoom out to the market they operate in. The Nordics, often described as stable, mature. Sounds like a nice place to be an insurer.
It is, structurally speaking. You've got high wealth levels across Denmark, Sweden, Norway. People have valuable things to insure. Nice houses, cars, electronics. And crucially, insurance penetration is very high. People tend to insure almost everything.
And it's not just sitting still, this market. There's still growth.
Yeah, surprisingly good growth, actually. It was about, USD 39 billion in 2022. Forecasts see it hitting over USD 57 billion by 2029.
Wow, that's nearly a 6% compound annual growth rate. Where's that coming from?
It's a mix. Some is just inflation and general wealth increase, but there's also growing demand for newer types of insurance that think cyber risk, more sophisticated health policies, things like that.
You mentioned it's concentrated, though. Intense competition, but only among a few big players. Sounds like high walls around the castle.
So that's a great analogy. The barriers to entry are significant. Look at market share. Sweden, the top 4 players have something like 81% of the premiums. Denmark, it's over 60%.
And what keeps newcomers out? What are those walls made of?
Two main things. First, regulation. Solvency II, the European standard, demands huge capital reserves. It's just incredibly expensive for a new company to build up that kind of capital base to compete at scale.
Okay, capital is one barrier.
Second is just the sheer difficulty of building a trusted brand and a distribution network across 3 different countries with distinct cultures and systems. It takes immense time and money. Smaller players or potential disruptors just can't easily replicate that.
And Tryg sits right at the top of this structure. Clear leader in Denmark, nearly 25% share?
24.5% in 2023, yeah. And number 3 in Sweden with their Tryg A brand. Number 4 in Norway. They're woven into the fabric of the whole region.
Which brings us to Denmark specifically. You mentioned it's the most profitable market in the Nordics.
Yes, inherently so. The market average combined ratio in Denmark in 2023 was already a very healthy 87.1%.
Okay, so the whole market is profitable. But Tryg is hitting 81.0% consistently. That's a huge gap, like 6 points better than average. How do they maintain that? Is it sustainable?
That's the multi-billion-dollar question, isn't it? The analysis argues, yes, it is sustainable because of what they call a virtuous cycle.
Virtuous cycle, meaning?
Meaning their superior profit margin allows them to reinvest more heavily in that data analytics and risk modeling tech we talked about. That sharpens their risk selection even further for the next year, pushing the claims ratio down again. Plus, their scale gives them cost efficiencies.
So profit funds better tech, which drives more profit.
Exactly. It's a self-reinforcing loop. It cements their leadership, makes their earnings super reliable, and ultimately, that's what justifies paying a premium price for their stock.
Okay, so we understand the market context and the profitability engine. Let's look inside the machine. How is Tryg actually structured? The biggest piece is the private segment, right?
Yeah, that's the foundation. Pulls in about DKK 26 billion in revenue. This is your everyday insurance. Motor, home, contents, pet insurance, some health stuff.
And the key characteristic here is predictability. You mentioned short-tailed risk.
Exactly. Short-tailed means claims usually get reported and settled relatively quickly, think within a year or so. Car accidents, storm damage to a roof, burst pipes, that kind of thing.
Why is that so valuable?
Because it makes the business much more predictable. You get a steady stream of claims data, cash flows are stable, and crucially, there's less risk that your initial estimate for a claim turns out to be way off years down the line. It's like a steady keel for the whole ship.
Okay, contrasted with long-tailed risks, which take longer to play out.
Right, like liability claims that might take years, even decades to settle. Much harder to predict the final cost.
Got it. Then there's the commercial side. They merged things there recently.
Yeah. They did. October 2023, they combined their old corporate and commercial divisions into one unit. The logic was synergy, streamlining underwriting, cutting costs, and making it easier to serve businesses, especially SMEs that might operate across, say, both Denmark and Sweden. Simpler structure, more efficient.
Makes sense. Feed that efficiency back into the expense ratio.
Precisely. And then you've got a smaller but interesting piece called Tryg Trade.
What's that about?
It's a bit different. It provides diversification. They're the biggest player in the Nordics for surety bonds, those guarantees needed for big projects like construction. And they also do trade credit insurance, which protects businesses if their customers default on payments.
So less correlated with the standard ups and downs of car and home insurance.
Exactly. And interestingly, Tryg Trade actually has a bit of an international footprint, offices in about 11 European countries, including places like the UK and Germany. Gives them a little exposure outside the core Nordic region.
Looking at where the money comes from geographically, you said Denmark is 47%, Sweden 31%, Norway 21%. Pretty balanced. But the performance in each country tells a story about management's actions.
Oh, absolutely. Sweden, for instance, has been a real star performer recently. Q3 2025, they reported a combined ratio of, wait for it, 70.7%.
70.7. That sounds almost too good to be true. Is that sustainable or just a really good quarter? How are competitors not just undercutting them massively if they're that profitable?
Yeah, 70.7 is exceptionally low, likely helped by favorable conditions that quarter. But it definitely signals a big improvement in how Tryg A, their Swedish brand, is operating. The analysis suggests it's down to successful integrating the business they bought from RSA, we'll get to that, and also actively shifting the portfolio towards better risk customers.
And competitors can't just copy that.
It's hard to copy their data advantage. Tryg might see a risk as profitable, where a competitor with less sophisticated modeling sees it as average or poor. So Tryg can price it keenly but still make a good margin, or maybe bundle it with other services where they add value. It's not just about the headline price.
Okay, Sweden the star. What about Norway? That's often seen as a tougher market.
It has been, but Norway is the turnaround story. Management went in there with a clear plan. Over the first 9 months of 2025, they improved the combined ratio by a hefty 5.1 percentage points, bringing it down to 86.7%.
How do they do that? Just hike prices?
Partly targeted repricing, yes, in segments that weren't making money, but also, crucially, disciplined underwriting, meaning they actively cut back on writing policies for customers or segments deemed too high risk or unprofitable. They chose margin quality over just chasing volume. That's a key sign of good management.
Even in Denmark, their home turf, there was a slight dip recently, Q3 2025 to 81.9%. But there was context there, too.
Yeah, the report noted that dip was partly due to some technical adjustments after they had actually put through quite aggressive price increases earlier to combat inflation's impact on claims costs. So they're being proactive on pricing, even if it caused a temporary blip in the reported number.
That proactive management seems like a theme. The analysis highlights strategic de-risking completed in 2023. Ahead of schedule.
Yes, this is really important. They made a deliberate decision to significantly reduce their exposure to certain types of volatile long-tail insurance lines, specifically things like U.S. liability insurance and property insurance outside the Nordics.
Why was shedding that business so critical? Less revenue, surely.
Less revenue, yes, but much higher quality earnings. Those long-tail lines, especially from places like the U.S. legal system, can have claims costs that explode unexpectedly years after the policy was written. It creates huge uncertainty in your reserves. By cutting back, Tryg basically said, we prefer predictable, stable profits from our core Nordic business, even if it means slightly lower overall volume. It massively reduced the risk of nasty surprises in their earnings down the road.
Trading volume for predictability. Makes sense. Lastly, on structure. How do they actually sell this stuff? Distribution.
It's multi-channel, direct sales, online and phone, tied agents, independent brokers. But the really powerful element is their strategic partnerships.
Like the one with Danske Bank.
Exactly. That bancassurance deal is huge. It gives Tryg direct, low-cost access to Danske Bank's millions of customers across all 3 main Nordic countries. It's a massive distribution pipe for both personal and business insurance.
And for their big corporate clients who operate globally. They don't try to build offices everywhere.
No, that would be inefficient. They partner. They have an alliance with AXA Corporate Solutions. So if a big Nordic company insured by Tryg needs cover for its operations in, say, Asia or South America, Tryg can arrange that through AXA's global network, which covers over 90 countries.
Smart. Keep the focus on the Nordics, but still service global needs.
Right. It lets them keep those big clients happy without diverting capital and management attention away from their core high profitability markets.
Okay, let's dive into the financials themselves. Looking at the last 5 years, 2020 to 2024, top-line revenue grew a lot, right? From around DKK 22 billion to nearly DKK 39 billion.
Yeah, big jump in revenue, partly boosted by that RSA acquisition we mentioned, but you're right to look past just the top line. The real measure of their core performance is the insurance service result.
That's the profit purely from the insurance business, before investments kick in.
Exactly. Pre-tax, pre-investment. It shows how good they are at the actual job of insuring. And that number more than doubled over the same period, from DKK 3.2 billion in 2019 to a record DKK 7.3 billion in 2024.
Wow, okay. So the underlying profitability got much, much stronger.
Hugely stronger. It shows the scale benefits, the tech investments, the de-risking. It's all translating into real recurring underwriting profit.
And the combined ratio, we keep coming back to it, but that trend confirms the story. 81.0% in 2024, and then even better in Q3 2025 at 78.6%.
Yeah, that downward trend is incredibly impressive, puts them right at the top globally. And a key driver of that low combined ratio, besides good claims results, is their efficiency on costs, the expense ratio.
How does that stack up?
It's very low and very stable. Around 13.5% in 2024, maybe even a touch lower more recently. That covers everything, not claims-related IT, salaries, rent, marketing, commissions.
So they run a leaner operation than most.
Significantly leaner. That 13.5% gives them a durable cost advantage. It means they have a built-in buffer. If claims costs spike unexpectedly due to weather, for example, they can absorb it better than competitors with higher overheads. Or they can use that cost advantage to price more keenly for the best risks.
Okay, so the underwriting engine is humming. But you mentioned investments can throw a wrench in the works sometimes. 2022 was an example.
A perfect example. In 2022, the underwriting side, the insurance service result, was strong. But they reported a big loss on their investments, nearly DKK 1.2 billion.
Ouch. What caused that? Rising interest rates hitting bond values.
Primarily, yes, market volatility, and that investment loss dragged their overall profit before tax down significantly, even though the core insurance business was doing well. It really highlights why you need to focus on that underlying insurance service result as the measure of true quality.
So how do they manage this investment risk? They have a big portfolio, DKK 60 billion or so?
Yeah, it's substantial, but they manage it quite conservatively. It's split into two main parts. About three-quarters of it is in what they call the match portfolio.
Match portfolio, meaning it's designed to match their liabilities.
Exactly. It's mostly fixed income bonds, high quality stuff. The duration, the interest rate sensitivity of this portfolio is carefully managed to offset changes in the value of their insurance liabilities caused by interest rate moves. It's primarily for hedging, not really for generating big returns.
Okay, so 75% is for safety and matching. The other 25% is the free portfolio. That's where they try to make some extra money.
That's the idea, yes. But even there, they've been getting more conservative. There was a notable shift towards the end of 2024. They started moving more of that free portfolio into really high-quality Scandinavian government bonds and covered bonds.
So deliberately choosing lower risk, even if it means potentially lower returns.
Seems so. It signals management wants the company's value driven by that predictable, excellent underwriting profit, not by taking big bets in the financial markets. Predictability is king.
Let's dig into that interest rate effect again, because it's a bit counterintuitive. You said rising rates hurt their bonds but help their liabilities. Can you unpack that asset liability matching, or ALM, a bit more for us?
Sure. Think about the claims Tryg expects to pay out years, even decades, in the future. That's a liability. When interest rates go up, the basic financial math says that the present value of a future payment goes down. Why? Because you need to set aside less money today to meet that future payment, as the money you set aside will earn more interest in the meantime.
Okay, so higher rates discount future liabilities more heavily.
Precisely. So when rates rise, Tryg might report mark-to-market losses on the bonds in its match portfolio. That's the asset side hit. But simultaneously, they get to apply a higher discount rate to their huge pile of future claims reserves. That's the liability side benefit. Often, these two effects largely offset each other, which is the whole point of ALM. It stabilizes their capital position against rate swings.
Right, it's a complex balancing act. And all this careful management shows up in their capital strength, that solvency ratio.
It really does. It's the ultimate proof of their balance sheet health. Consistently strong, 196% in 2024, and it actually ticked up to 204% by the third quarter of 2025. That's comfortably above what regulators require.
And that underpins their credit rating.
Yes, that strong solvency is key to their A1 rating from Moody's. It gives policyholders and investors confidence.
One last check on the financials. Accounting quality. Insurance accounting relies heavily on estimates, especially for future claims. How does Tryg look there?
They get very good marks. The key evidence is something called positive runoffs.
Positive runoffs, what does that mean?
It means that when they look back at claims from previous years, the actual amount they ended up paying out was less than the amount they originally set aside or reserved for those claims.
So they were consistently cautious, maybe even slightly pessimistic in their initial estimates.
Exactly, and that's what you want to see as an investor. It shows prudence. It proves they aren't flattering their current year profits by underestimating future costs. Consistent positive runoffs are a really strong signal of high-quality, conservative accounting and reliable earnings.
A lot of Tryg's current scale and strength, especially in Sweden and Norway, comes from a major acquisition they did back in 2021, buying parts of RSA's Nordic business. That must have been a huge integration challenge.
Enormous. Integrating large businesses across different countries, different systems, different cultures, it's notoriously difficult. But Tryg absolutely nailed the execution. That's a massive credibility point for the management team.
They delivered on the promised savings, the synergies.
They did, and then some. They racked up DKK 930 million in accumulated synergies by the end of 2024. And importantly, they did it faster than they originally projected.
DKK 930 million. Where did those savings actually come from?
It's the usual suspects in big mergers, done well. combining IT platforms, reducing duplicate administrative roles, getting better deals from suppliers, think reinsurance, or bulk buying parts for car repairs because of their increased scale, and just making the claims process more efficient across the board.
So successfully pulling off that complex integration gives investors confidence they can deliver on future plans.
Absolutely. It significantly reduces the perceived execution risk for whatever they want to do next. They've proven they can handle complexity and deliver results.
Which leads us nicely to what's next, their big strategic plan out to 2027. What are the headline targets?
They're ambitious. Building on that DKK 7.3 billion insurance service result in 2024, they're aiming for somewhere between DKK 8.0 and 8.4 billion by 2027.
So roughly another billion kroner in underwriting profit improvement.
Yeah, substantial growth. And they plan to do it while keeping that combined ratio around the same excellent level, roughly 81%. And they're targeting a very high return on own funds ROE of 35 to 40%.
35 to 40% ROE. That sounds incredibly high compared to, say, a bank. How's that even possible?
It's a combination of factors. First, that extremely high underlying profitability from the insurance business itself. Second, it's how the capital rules work under Solvency II. Insurers can be quite capital efficient if they manage their risks well. Tryg runs a tight ship capital-wise. That 204% solvency ratio is strong, but not excessively padded. It means they generate a lot of profit relative to the shareholder equity actually tied up in the business. That high ROE target basically signals extreme operational efficiency and value creation.
Okay, and how are they planning to get that extra billion in profit? The plan has specific pillars, right?
It does, which adds credibility. It's not just a vague aspiration. Pillar 1 is technical excellence. They expect this to contribute DKK 500 million.
Technical excellence. So more data, better pricing, smarter claims handling.
Exactly. Continuous refinement. Using their data edge to price risk even more accurately, manage claims even more efficiently, and fine-tune the mix of policies they write. Always looking to shave basis points off that combined ratio through underwriting skill.
Okay, $500 million from technical improvements. What's pillar 2?
Customer and commercial momentum. This is targeted to add DKK 300 million. It's about profitable growth, winning new customers, selling more products to existing ones, really leveraging that Danske Bank partnership, and strengthening their position in the SME market.
So smarter selling and organic growth. And the third pillar?
IT and scalability. This is expected to chip in DKK 200 million, mainly through cost savings and efficiency gains. This is really the backbone investment for the future.
What are they doing specifically on the IT front?
The big project is modernizing their core IT infrastructure. They're rolling out a new, unified underwriting platform across the group, aiming for 80% adoption by 2027. Standardizing systems gets rid of complexity inherited from mergers, allows more automation, and makes it easier to deploy their advanced analytics tools right at the point of sale or underwriting. It should help keep that expense ratio low and stable.
So it's not just relying on the market growing, it's very much about internal improvements and targeted initiatives.
Precisely. They're not just hoping for growth, they're engineering it. For instance, on the commercial side, they're setting up specific new partnerships, like in the Swedish private motor ecosystem, think repair shops, dealerships, etc., which they expect to start adding to growth from 2026 onwards. It shows a detailed roadmap, not just broad goals.
Let's pivot back to the shareholder returns, because that's clearly a big part of the Tryg story for many investors. Their dividend policy is very explicit.
Extremely explicit. Their stated goal is a stable and nominally growing dividend every single year. No ambiguity there.
And they followed through.
Yep. The 2024 dividend was up over 5% to DKK 7.80 per share, and they pay it out quarterly, which income investors like. And then on top of the dividend, they use share buybacks when they have excess capital. That DKK 2 billion buyback announced late 2024 is a good example. It's a flexible way to return cash when the solvency ratio gets significantly above their target range.
But this is where that constraint comes in, the point Moody's raised. This aggressive payout policy creates a tension, doesn't it?
It really does. It's perhaps the most interesting strategic choice they've made. By committing so strongly to annual dividend growth and using buybacks, they are running a very capital-efficient balance sheet, which boosts ROE.
But it leaves less room for error, less buffer if things go really wrong.
Potentially, yes. It means if they face a massive unexpected shock, maybe a truly unprecedented series of storms or a sudden regulatory capital change, they might face a difficult choice. Cut the dividend or jeopardize their solvency ratio. The policy prioritizes current returns over maintaining a huge, just-in-case capital cushion.
Okay, so what are the specific risks that could really test this policy, test that balance? Catastrophe risk seems like the obvious one, especially with climate change.
Absolutely number one. The Nordic region isn't immune. We're seeing more frequent and more severe weather events, windstorms, floods, heavy rain. 2023 showed how costly that can be. This directly threatens their claims costs and thus their combined ratio.
How do they manage that risk? They can't control the weather.
Their main defense is reinsurance. They buy protection from large global reinsurance companies. Essentially, they pay the reinsurers a premium to take on the risk of very large, infrequent losses above a certain level. It's expensive, but it caps their potential downside from mega catastrophes and protects that crucial solvency ratio.
Okay, reinsurance helps with the extremes. What about ongoing economic pressures? Inflation, interest rates.
Big factors. High inflation is a direct hit. It pushes up the cost of everything involved in claims: car parts, building materials, labor for repairs. If Tryg can't raise its premiums fast enough to match that claims inflation, margins get squeezed. That 81% combined ratio could creep up.
And interest rates. We know they impact the investments and liabilities.
Right, that complex ALM balancing act we discussed. Rising rates can hurt bond values, but help reduce the present value of liabilities via the discount rate. The risk is that this relationship doesn't hold perfectly or changes unexpectedly. Maybe bond losses are worse than expected, or maybe regulators change how liabilities are discounted. It introduces potential volatility to the P&L even if the underlying insurance business is stable. Constant monitoring and adjustment needed there.
And finally, even in this concentrated market, they can't ignore competitors.
Never. Their main Nordic rivals, Sampo's Thesis. If P&C, Gjensidige, Top Denmark are also large, sophisticated, well-run companies. They're all fighting hard on price, on service, on digital offerings. Because the market isn't growing explosively fast, any attempt by Tryg to significantly expand its margins will likely be met by competitors responding aggressively to protect their own share. It puts a kind of natural ceiling on profitability. They need relentless focus on cost control just to maintain their edge.
So we've painted a picture of a high-quality, well-managed leader in a stable market, but with real risks and a potentially demanding shareholder policy, which brings us to the price tag. Tryg trades at a premium valuation, right? Higher PE, higher price to book than peers.
It does. PE around 20x, price to book about 2.6x based on the analysis figures. Definitely not cheap compared to the sector average.
So how do you justify paying that premium? What's the argument?
The argument boils down entirely to that superior, consistent operational performance. You're paying up for quality and predictability. Look at the combined ratios again. Tryg at 81.0%. Compare that to Sampoif P&C at 84.3%, or Top Denmark, which was around 88.0% in 2023.
So Tryg is just fundamentally more profitable at the core insurance business, 3 to 7 points better.
Exactly. That translates into significantly higher and arguably more reliable earnings generation from every premium dollar. The market recognizes that quality and assigns a higher multiple to those earnings.
And does the underlying value creation support the high book multiple, the return on equity?
Yes. The analysis points to a normalized ROE of about 12.90%. While that's lower than their ambitious 35-40% target, which includes leverage effects, it's still comfortably above the likely cost of equity for a company like Tryg. When ROE consistently exceeds the cost of capital, it means management is genuinely creating value for shareholders, which provides fundamental support for trading above book value.
We talked about competition being fierce. How much protection does their brand give them? Things like Tryg, Hansa, Alka, these are household names.
Brand trust is a significant intangible asset, definitely. In insurance, people often stick with names they know and trust. And while, yes, an individual could switch their car insurance fairly easily to save a few kroners,
It gets harder if you have multiple policies bundled together.
precisely. Tryg is very focused on bundling home, auto, travel, pet insurance, all with one provider. Once you're bundled, the perceived hassle of shopping around and unpicking everything to move all your policies elsewhere creates inertia. It acts as a practical switching cost, helping them retain customers even in a competitive market.
Okay, so let's wrap this up. The deep dive suggests Tryg is a top-quality insurer, market leader, best-in-class operational discipline shown by that stellar combined ratio, and a management team with proven execution skills, particularly with that RSA deal.
That's the essence of it. Their success seems driven more by internal discipline and strategic choices, the de-risking, the tech investment, the cost control, rather than just riding a wave of market growth. You really have to watch that insurance service result. That's the true engine.
Which brings us back one last time to that core tension. the conflict between their aggressive shareholder return policy and the rising risks, particularly from climate change. That's the key thing for you, the listener, to ponder going forward.
Exactly. The provocative thought is this. We see increasing volatility from weather events hitting the Nordics. We see Tryg's very clear public commitment to growing that dividend every single year, which constrains their capital flexibility somewhat. So the question becomes, how long can they sustain both? At what point might intensifying climate costs force a difficult choice between maintaining that fortress solvency ratio and delivering on that ambitious dividend promise? That interplay between risk, capital, and shareholder returns, that's the drama to watch with Tryg in the coming years.